So, you have understood consumption function. Now, let us understand another important key economic driver, that is investment. Let's go to the boardroom of Mr. Karthik, where a major discussion for investing in machinery of 10 millions is going on. Mr. Karthik runs a company that produces multimedia content for higher education. In boardroom discussion for investment for next year is going on. Because of general slump in the market, company has faced less sales in last year, and because of that company has ended up in increased investment in inventories. There are 100,000 DVDs currently sitting in our warehouses on December 31st. 2008 ready to be shipped to dealers. DVD has a wholesale price of $1,000. So company has an inventory worth $100 million. We also have additional inventory investment, that is, the level of raw materials, content in half-baked shape, and parts DVDs bought. On December 31st, 2008, we had $20 million of half-baked content to convert into finished output. It is important to understand that there are two types of investment that we make. The first type, fixed investment, is the spending by us on equipment, that is, machines, computers, software license cost, and structures, that is, content generation factory, office buildings, retail shops. The second type, inventory investment, is spending by us on additional holdings of raw materials, that is, half-baked content, parts, that is, DVDs, and finished goods, that is, multimedia content DVD, calculated as the change in holdings of these items in a given time period, say a year. An important feature of inventory investment is that, in contrast to fixed investment, which is always planned, some inventory investment can be unplanned. Now, question to all of you. We are increasing fixed, that is planned investment, because we are expecting the demand for DVDs to pick up and balance this year's sluggish response. But what if by December 31st, 2009, our inventory of DVD has risen to $150 million? Despite of reducing investment in unplanned inventories, we will end up in increasing unplanned inventory investment in 2009 by $50 million. That is, the change in the level of its inventory over the course of the year. That is, $150 million minus $100 million. In this situation, we will be producing more DVDs than we can sell and will have to cut productions. Now suppose that we will get great response from the market and there is a drop in the level of inventories. Inventory investment might be negative and we may not be able to furnish it and hence will lose market share. In this situation, we will be producing less DVDs than we can sell and will have to increase production. Also, our decision to invest depends on the cost of funds that we are going to put for buying all the assets. If the cost is low, then we might go for high risk taking. So, what should we do now? This discussion in Mr. Karthik's boardroom is an intuitive way to understand planned investment spending, a component of aggregate demand YAD. As mentioned by Mr. Karthik, it is equal to planned fixed investment plus the amount of inventory investment planned by firms. You might have noticed there were two key factors, that were influencing planned investment spending of firms, and they were interest rates and businesses' expectations about the future. Keep these two factors in mind because it is going to be a base for the next module. As of now, in the first module, we will take planned investment spending as a known value. At this stage, we want to explain how aggregate output is determined for a given level of planned investment spending. We can then examine how interest rates and business expectations influence aggregate output by affecting planned investment spending. By the way, the decision taken by Mr. Shashank on residential housing will come under planned investment spending and not in consumption. Through the small stories of Mr. Shashank and Mr. Karthik, we have now assembled the building blocks, that is, consumer expenditure and planned investment spending. That will enable us to see how aggregate output is determined in an economy. Of course, this model is still simplified and unrealistic, as we have discounted a lot of other spending in economies by other participants, such as government. However, this stripped-down analysis clarifies the basic principles of output determination. In the next section, we will bring government into the picture to make our model more realistic. The diagram below, known as the cross diagram, shows how aggregate output is determined. The vertical axis measures aggregate demand, that is, the demand generated by consumers and firms for goods and services in an economy. It is represented by YAD, and the horizontal axis measures the level of aggregate output that an economy can produce. It is represented by Y. The 45-degree line shows all the points at which aggregate output Y equals aggregate demand YAD. That is, it shows all the points at which the equilibrium condition Y is equals to YAD is satisfied. One important thing to understand here is that aggregate income, the total income of factors of production, that is, land, labor, and capital, from producing goods and services in the economy during the course of the year, is best thought of as being equal to aggregate output.